This will be a big week for economic data, and this is going to largely shape what the Fed is going to do. The problem is that we're relying on really bad jobs data that's been really subject to massive revisions the last couple of months. And so nobody knows really what this data could look like by the time we see it on Friday morning. We'll be getting the ISM manufacturing report. We're looking for that to come in at 49 versus 48 last month. Then we'll be getting on the third, JOLTS, which is another impossible number to predict, 7.3 million down from 7.4 million. On the fourth, we'll be getting ADP, 68,000 versus a prior read of 104,000. Initial jobless claims are always an important number. We'll be getting unit labor cost revisions, S&P Global services and numbers, and ISM services expected to increase to 51 from 50.1. And then, of course, the big job report on Friday morning. We're looking for 75,000, up from 73. The unemployment rate's expected to increase to 4.3% from 4.2. Average hourly earnings 0.3, flat to last month, year over year, down 3.7 from 3.9. But before we get too much further, I just want to remind everyone to please remember to subscribe to this channel, share it with your friends. I need you to help me grow the channel, and you can do that by showing your support and subscribing and following my work. As I already noted, this data has been incredibly difficult the last couple of months to parse. The numbers for the month of May and June, when they came in initially, looked fairly strong at 140,000 apiece. And then all of a sudden they're revised down to just 19,000 and 14,000. So those were, big revisions, 120,000 decline, 130,000 decline. And it was really just in the March numbers that we saw also a very big decline. So it makes it really hard to actually predict, what this is going to come in. If we can't really predict what this is going to be, then how are we supposed to guess in terms of what the Fed is likely to do? And another problem that we have is when we look at some of the other data points, is that, we have a lot of mixed data. We have, data points like, the consumer confidence numbers. They come in with the jobs hard to get category. And that number has been steadily increasing the last couple of months, but yet the unemployment rate has been relatively staying flat. And what's interesting is that typically this consumer confidence jobs hard to get number is pretty good leading indicator to where the unemployment rate is actually going to be going. And right now, it seems to be suggesting the unemployment rate should be rising. But as of right now, we haven't seen anything in terms of the unemployment rate actually moving up. And this is important because, largely speaking, the yield curve tends to move with the unemployment rate as well. We typically see the yield curve steepen when the unemployment rate is rising, and we typically see the yield curve flatten and invert when the unemployment rate is falling. And so we've been kind of seeing that the yield curve started moving up a little bit as the unemployment rate rose, kind of starting in the summer months of 2022. But for the most part, the yield curve has really been flat now since probably, I would say, the spring of 2025. And so, again, we're kind of waiting to find out what's going to ultimately happen with unemployment. When you look at some of the data points, it would suggest that unemployment rate should be rising. We've certainly seen continuing claims going up, and that would suggest the yield curve should be steepening. We're just not. We're kind of still waiting on that. One reason why unemployment rate probably rises because, jobs are getting harder to get. The reason why jobs are getting hard to get is because the number of job openings have declined. And so we're looking at the Indeed data versus the JOLTS, which is, again, a very difficult number for the analysts to predict. And it's always subject to massive revisions. And I doubt that this month will be much different. But, you can see that the number of job postings on Indeed have continually trended lower, and they've really kind of continued to trend lower even into the July and August readings. And remember, the JOLTS data we're getting this month is for the July month because it runs a month behind. But ultimately, what Indeed's also showing us is that while job openings have really just kind of flattened out, so there's really not been much of an improvement in terms of the number of job openings, and that would continue to suggest that it's probably going to be harder and harder to get a new job if you've lost your job, which again speaks to the fact that we should be really seeing the unemployment rate rise. One reason why we haven't seen the unemployment rate rise, and this is one of my theories that I'm working with at the moment, is that all of a sudden we've seen the number of people not in the labor force really begin to increase. And it's not entirely clear to me why that could be happening. It could be happening for several reasons. It could be happening because a number of baby boomers are retiring and they're leaving the workforce. It could also be that the number of people who are unemployed are kind of falling out of the unemployed category and are simply being put into the not employed, not in the labor force category. So what typically happens is you're only considered unemployed, if you're looking for work, if it's only for a certain length of time. So if you're in this category where you're, unemployed, but you've been looking for work, let's say for 3 months, you may no longer be eligible to be counted as unemployed. You may now just be considered no longer in the labor force. And it's very possible that if we're in a period of time where jobs are getting harder to get because the number of job openings are declining, that we could be in this period where perhaps the number of people who are actually unemployed aren't necessarily finding jobs, but it could just be that they're no longer being counted as being unemployed. And that's why you're seeing this very big and really sudden rise in the year-over-year rate of change for the number of people not in the labor force. In fact, when we just put this number back to flat and neutral, what you see is that the number of people not in the labor force has really started to turn up in a really meaningful way over the last last several months, really going back to, I would say, September of 2024. You can see that we went from 100-ish million people to about 103.5 million people over that time. And so that's a pretty big increase, and that's a pretty big rate of change. I guess if we look at it from one other perspective and look at it from a year-over-year per change, you can see that's a really pretty big change, a number we haven't really seen in a fairly long time. In fact, you haven't seen really, if you remove COVID from the equation, you haven't really seen a 3% rise in the people not in the labor force since periods in 2013. But that was really coming down from the big rise we had going into 2008, 2009, and 2010. And so that typically seems to occur during periods of recession and economic slowdown. Here's another period here in 1990. Here's this period in here in 2000. And then, of course, in the 1980s, we know we had that double dip recessions. So that could be sort of a leading indicator here that the economy is really starting to maybe teeter on the brink of recession. In fact, I'm saying it that way because this is actually the first time I've seen this chart. I just kind of thought of it as we were going through the video. And so that will be something that we'll really need to watch when we get this next round of data. And so when we kind of just bring this back to the market and we kind of just think about where, interest rate policy is right now. Again, right now we're right. I know that the odds are for an 85 basis point rate cut, right? I know the odds right now are around 85% for a rate cut in September. But, you have to realize that right now the Fed funds are at 4.235. And so it's not really going to take very much for this number to kind of swing in a direction that may quickly increase those odds to 100%, but yet at the same time quickly remove any odds of the Fed actually cutting rates, because the actual Fed funds rate is set at 4.25% to 4.5%. And so right now we're just barely below that lower bound. And if we started to see that number move back up over 4.25%, that would start reducing the odds of a rate cut. And you can even see that as of right now in December, we're still at 3.84%. So not really a major change. This was when we got the job report in August. We were looking at potentially not getting any rate cuts this year. We were actually moving higher. And then all of a sudden the job report came out and everything changed. And so, who knows? We could get a job report this month that comes in stronger than expected, and we could see all the odds of a rate cut disappear, and we can see this number quickly go back higher again. It's one of those situations that you're relying on trying to make an educated guess on a data point that's in a way flawed and hasn't really been working correctly now for some time, and it really leaves you uncertain in terms of how this could really come in. And so the one thing I'll be watching very closely on Thursday is this VIX 1-day. We know that the VIX 1-day is a very important indicator because it can tell us a lot about where volatility is heading into an event. And typically the higher the VIX one day is, the more likely it is that you're going to get some sort of volatility crush the following day. And so, going into the payroll report in August, we had this big spike, and then of course the numbers were bad and volatility actually went even higher. And then of course it crushed on that Monday and we got the big rally. And then we had the CPI report, big rise in implied volatility, crush led to the market rallying. Jackson Hole, big rise in implied volatility right up until the event, and then the big crush sent the market higher. This was actually NVIDIA. But if we go back even further in time, I have these all kind of laid out here with different periods where we saw these previous NFP job reports where we tend to get these really big spikes heading into the job report, and then that tends to lead to some sort of move. And this was obviously going into Liberation Day and such, so we shouldn't pay attention to that. But clearly you can see the trend is for implied volatility to rise going into that. I actually just did a recent video explaining to the members area about how implied volatility rises into events and then how it crushes after, and how that helps to impact the markets the next day, really almost totally independent of what the news is. And again, this is another component that we're likely to see as we go into this kind of flawed job report that's coming, and I'm using quotations around saying flawed job report that we're likely to get on September 6th, and the potentially big impacts it's going to have, not just on monetary policy, but on the shape of the yield curve and even the shape of the equity market. So this is going to be an important setup, and it's not going to be probably something that anyone's going to really be able to prepare for very well, but it's one that we have to kind of get over, and we'll see what happens come Friday. Anyway, please remember to subscribe to this channel, like this video, share it with your friends, and we'll see you again soon.